In this session, let's start looking at the valuation based on the residual income. This is also one of the discounted cash flow mechanisms of valuation itself. Earlier we have looked at using the dividend discounting model as well as the free cash flow based discounting model to evaluate the stock. The same thing on the similar lines we will be looking at the residual income based valuation model, but the clear cut difference is when we talk about the residual income, it is purely based on the income statement. The values are picked up from the income statement. Wherever when we had talked about the free cash flow, we were computing the free cash flow using the elements of the income statement as well as the balance sheet. So this is purely from the accounting based income statement itself rather than the real cash movement. So the valuation which we are doing here is slightly different from the other two mechanisms, wherein the intention is to compute what we call as the residual income for the future, and based on that try computing what is the value of the security, right? So what is the way we are defining this residual income? In a way we also call it as economic profit. So the way we are defining this residual income is nothing but whatever the accounting income that is there, from this accounting income subtract what is the expected return of the equity investor. So let's say from an accounting process, once we have got through the EBIT phase, we generally deduct the interest that needs to be paid to the lender, which will take us to profit before tax, and from here we deduct the tax and say this is the net income. Now this net income may be positive, but is it in line with the equity investors' expectations, or has it exceeded the expectations, or has it fallen below the expectations? That is what is the definition of the residual income. Whatever the accounting income that has come out, if I subtract the expectation of the equity investors, how do I know what is the expectation of the equity investors? Whatever was the equity capital that is there, multiplied by the required rate of return of the equity investors, that is what is giving me what is the return that this equity investors are expecting. So the focus here, don't just go with NI is positive. Is it really meeting the expectations of the equity investors? Now if it has met and if it has exceeded, probably there is going to be a positive vibe about that particular security. If it has fallen below the expectation, probably it might be treated negatively by the equity investors, because this is more to do with meeting the expectations or not meeting the expectations or even exceeding the expectation. So that's where we say this is a measure of economic income, not just the accounting income. So whenever we are trying to compute that particular residual income, we are looking at by how much is it exceeding the expectations. So if the security is going to exceed the expectations for the next few years, obviously the investors would be more interested in buying it, and the value of the security is typically planned to go up. So that's where we say ROE minus R is the key determinant, because ROE is purely based on the net income divided by the equity capital is what we are calling as ROE, minus R. R is the required rate of return. So This is what the rate of return which the company has generated minus R, required rate of return by the equity investor. So if this is positive, it is expected that the value of the company is going to go up compared to the current value. If it is lesser, the value of the firm is going to go down. So ROE minus R is a key factor, and at the same time the growth rate, the rate at which the company is planned to grow. Here the intention is, why am I bringing in the growth rate? Growth rate is what will contribute. We have earlier looked at the growth is coming by ROE times the retention ratio. So if the growth is very high, I can expect that over the future the residual income is also going to go up. But if the growth is going to be much lesser, probably the residual income may come down drastically. So to understand how the residual income is moving over the next few periods, we are looking at the growth rate also. So that's where we say the key drivers for the residual income are by how much is the actual performance, return on equity, greater than the required rate of return, and what is the growth rate. What is the growth rate in the residual income? If it is growing drastically, probably the value is going to be much higher. We'll see how do we find out the value using this residual income model. But we also see a couple of small variations of the residual income mechanism. One is the market value added, which is nothing but the total market value of the firm. When I say total market value, the value of debt, market value of debt plus market value of equity, whatever, that is the total from a market dimension. What is the value of this particular firm minus the invested capital, which is nothing but by how much extent did the value of the firm increase over what has been invested. So right from the inception phase, right from the inception stage, by what extent is the market value above the invested capital? The higher it is, the higher the value addition that has happened in the process. So by what extent the management's decisions have really influenced the stock market. That is what the market value addition as a tool is performing. Even this can be computed year over year, discounted to the present value. All these kind of things can very well be done to find out the value of that particular stock. So generally this is not used from a valuation dimension, but most of the times it can be used from performance appraisal kind of a dimension, probably to appraise the managers, and so decision analysis kind of stuff. All these things can be done quite effectively using this market value added. There is another dimension called economic value added, which is a slight extension to this concept of residual income itself, because in the residual income we are taking the net income minus whatever the required rate of return times the book value of equity. So this is purely targeted towards the equity investors, whereas when I am using the economic value add, I am targeting the whole firm, not just my equity investors. So instead of NI, I will be taking EBIT into 1 minus T, because EBIT into 1 minus T is the benefit which is generated, is the profit which is generated both for debt as well as equity investors, which is an equivalent of NI, equivalent of net income when I am taking it at the firm level. So R is the required rate of return by the equity investors. Now when I take the firm based investors, then R is same as weighted average cost of capital. And when I am looking at book value, this book value is of equity. I take it to the firm level. This is equal to the invested capital, which is nothing but the summation of debt and equity. So basically, I can very well look at the economic value add as by what extent the profit of the firm increased the expectations of the investors. So if the profitability of the firm is much more than what the investors as a whole have expected, it is going to generate a very positive economic value added. Otherwise, it is going to create a negative value addition. But before we compute this EBIT and all, getting into this particular EBIT into 1 minus T, we actually call it as NOPAT, net operating profit after tax. Here, some things that are advised are, before you actually compute the net operating profit after tax, make these adjustments. R&D, generally you may treat it as a part of operating expenses. Operating leases, you will treat it as operating expenses. Whichever the things which can be capitalized, all these things you better do a capitalization and then go to the computation of NOPAT. Otherwise, we will see the results very heavily fluctuating. So it is suggested that whichever are these things that can be capitalized, especially R&D, operating leases, goodwill, and any kind of amortizations that are being done, all these things you better capitalize them, and based on those capitalized values, update the income statement, and from there compute the profit after tax, operating profit after tax. Same way deferred taxes, don't get into the deferred taxes, look only for cash based taxes. With all these adjustments, you get into the computation of net operating profit after tax, and from where you can get into the computation of the EVA part. Whereas the focus of this session is primarily on residual income itself. What we are saying is, even you can try to work out with economic value add and market value add also as the tools for as the tools which are resembling the residual income or the economic profit. So just to compute, getting into a small numerical aspect, right, which is involving the computation part. Let's say if I am saying EBIT is this much, okay, let's take one small calculation. EBIT is 442, interest is 93.4. So from here I can find out that my profit before tax or earnings before tax is 348.6 million. Alright, out of that I am paying a tax of 78.1 million, which is giving me that my net income is going to be 270.5 million. Fair enough. This is the accounting net income part. Then I have my total debt 159.4 million. Equity is 1558 million. Okay, so I'll take it into a spreadsheet. Debt 159.4 million and equity 1558 million. So based on that, I can find out my debt proportion. The debt proportion is this divided by the summation of these two. So my debt is forming around 9.2%, whereas the equity is somewhere close to 91%, right? So this is the proportion weightage of debt and equity. Required rate of return on equity is 14.5%. Okay, required rate of return on equity is 14.5, whereas post tax KD into 1 minus T, post tax cost of debt is 7%. Now we are asked to find out the residual income as well as EVA. So how do I find out the residual income from this NI? I need to subtract the R times the required equity return, right? Equity capital multiplied by R. This is the equity capital and this is the R. So basically it is giving me that the equity capital multiplied by R is somewhere around 225.9. So from here I subtract 225.9, which will give me the residual income 270.5 minus 225.9, working out to a residual income of 44.59 million. This is how we compute the residual income post the net income computation. We have to deduct a charge for the equity investors' required rate of return on the equity capital that has been invested. Now, how do I compute the EVA in this case? To compute the EVA, I require EBIT into 1 minus T. So generally I can take either a marginal tax rate, but in case the marginal tax rate is not available, I can go with the effective tax rate. So 78.1 upon 348.6. So the tax rate, effective tax rate, probably I can take it as 78.1 divided by 348.6. So giving me that this is the kind of a tax rate. So what I can do for computing the EVA, first I will compute EBIT into 1 minus T. So EBIT into 1 minus T, EBIT is around 442 times 1 minus T. So EBIT into 1 minus T is coming out to some 342. Out of that, okay, I also need to find out what is the weighted average cost of capital. So these are the weightages of debt and equity. This is anyhow post-tax debt. So from here I will get my weighted average cost of capital as weightage of debt into cost of debt plus weightage of equity into cost of equity, working out to somewhere around 13.8%, right? And the total capital, invested capital, is coming out to the summation of debt capital plus equity capital. So from here I can get my dollar WACC, which is nothing but the invested capital times the weighted average cost of capital, so 237. So from here the difference that we are getting is what we call as EVA, EBIT into 1 minus T minus the dollar WACC, giving me 105 million. So because this is positive, there is going to be a positive value addition, and if it is negative, it's going to have a negative value addition, and so on. So this is what we are trying to talk about when we are computing the EVA or residual income. But when I have to compute the MVA, I require the market value related numbers. Then when we are talking about any residual income based valuations, in general we use them for the effectiveness, for performance appraisals. The most common usage of the residual income based models is a part of the performance appraisal process, where the compensations or effectiveness of the management are primarily looked at. But apart from that, today they are gaining a sufficient momentum in the equity valuation process, especially where I cannot use even the dividend discounting model or even the free cash flow based model. a company doesn't declare dividends, or even the free cash flows are negative for those kind of companies, especially new companies where the free cash flows may very well, or capital intensive kind of companies or distressed kind of securities, these even the free cash flow based models are not applicable. So in those kind of cases also I can go forward and try to do the residual income based valuation model. So from that standpoint also we see that the residual income based valuation models have gained a lot of momentum in the industry. And whenever I am talking about computing the residual income, as we have seen in the earlier case, I will look at the net income of this current period, or probably EPS, depending on whether I am operating at a complete company level or one single share level, net income, and from there I subtract whatever is the required rate of return the equity investor is expecting, multiplied by either book value or book value per share. If I am operating at this level, I will multiply it with the book value of equity. If I am operating at EPS layer, I will multiply it with the book value per share at the beginning of the period. So this is what will give me the net the residual income for each of the periods, and projecting all the future periods residual incomes, discounting them to the present value will give me the value of the security itself. So that is what we are doing. Whenever we are trying to compute the residual income for the current year, we are looking at the EPS for the year and subtracting the required rate of return times the book value of the equity. So the other way of looking at it, EPS is nothing but, when I am talking about EPS, we are talking about earnings, which is the net income divided by, when we are talking about the earnings per share, earning is nothing but net income divided by the equity capital, right? So when I am dividing this by the number of shares, it is directly coming out. See, ROE is nothing but net income by equity capital, and what we are saying now is net income is nothing but ROE times the equity capital. Equity capital is nothing but book value, and when I say EPS, I can very well write it as ROE times BVPS. So when I say residual income is net income minus R times book value per share, or EPS minus R times book value per share, instead of EPS I will write it as ROE times BVPS. So that makes it ROE minus R times book value per share at the beginning of the period. So the book value of the share at the beginning of the period multiplied by the difference between the ROE and R. That is what is the measure of residual income for each of the periods. And when we are trying to do the intrinsic value calculation, we are taking the current book value and all the residual incomes for each of the years, future periods residual incomes. I am discounting them to the present value. All the future period residual incomes, I am discounting them to the present value using the present value kind of a method. So I am forecasting all these residual incomes for the future and discounting them to the present value. That is what we are calling as the intrinsic value. I will add up to this current book value, because only as a part of the residual income I am looking at the excess above the book value only. If ROE is equal to R, the market value will be equal to book value only. Means all these things will actually become zero. The market value should be equal to book value itself. Now that ROE is greater than the investor's expectation, in the future some additional benefit is going to be generated. So that's the reason I am trying to purchase the share at a premium. And when I am looking at, let's say, this entire thing is my future. So if I am saying it's a single stage model, probably I can look at this as an infinite period geometric series. So if at all I am assuming that Ri is going to be constant forever, if I am assuming the Ri is going to be constant forever or growing at a particular rate G, if I assume that Ri is growing at a constant rate G, that is what is a single stage growth model, Gordon growth model. Assume that the future Ris are going to grow at a constant rate G. Then the present value of all these things will directly become Ri1 divided by R minus G. And what is this Ri1? The next period residual income itself, which is nothing but the ROE minus R multiplied by the current book value. So that's the reason we are saying the value of the firm in case of a single stage model is the current book value plus ROE minus R times the current book value divided by R minus G. Now once I have this kind of a formula, okay, let me simplify it now. The value is equal to B naught plus ROE minus R times B naught divided by R minus G. This G is the implied growth rate. So probably I can make it as V minus B naught. In case of V, sometimes we take it as a price also. P naught minus B naught is equal to ROE minus R into B naught divided by R minus G. So from here I can find out R minus G is equal to ROE minus R times B naught divided by P naught minus B naught. And from here I can find out the G, which will give me the required rate of return minus ROE minus R times the B naught divided by P naught minus B naught. This is what is the implied growth rate inside this process also. So probably what you can very well do is, once we know that our process, that our model is following a single stage residual income, we can try to find out the value, or when I am equating the value to the price, I can get into the implied growth rate computation also. But the good thing here is, compared to a dividend discount model or free cash flow based model, this model is less sensitive to the concept of terminal value, because we are starting with this as the base. Whereas when we are talking about the free cash flow based model or dividend model, we are saying all the future cash flows, discount them to the present value. We are not starting with any base. Whereas in this residual income model, we are saying the current book value plus the excesses. So because the terminal value is only with respect to the excesses, we are saying that the sensitiveness of the terminal value is not that heavy compared to a free cash flow based model or a dividend based model. Right? Let's look at one mechanism to value the stock using this model itself. Okay, we are expecting that the required rate of return R is 12%. Fair enough. Let me take the numbers. R I am expecting as 12%. Current book value per share is $24.9. Fair enough. So to this 24.9, I have to do the futuristic estimations. Okay, EPS estimate for the next 3 years. All right, let me look at year 1, year 2, year 3. The EPS estimates for each of the years: 6.4 million, or EPS $6.4, $7.7 and $4.9. These are the EPS estimates. Fair enough. The dividend payout. Now that I have the EPS, this is the earnings per share. The dividend payout for the next 2 years. Okay, let me take the dividend. In the first year it is 75%. So out of this number, 75% is the dividend. Then in the second year it is 61%. So out of this year I am taking it as 61%. Then the third year we are talking about a liquidating dividend, which means I will add up the total book value that is still left. Okay. So for the third year, let me not compute it right away, and compute the residual income in each of the years and find the value of the stock. Now, the difference between the EPS and the dividend, this is what is going back to the book value computation. So I will take the book value per share now, the old book value per share, plus whatever is the difference between the EPS and the dividend, that is becoming the end of the year book value per share, right? Because this is going as a retained earning, which is adding up to the book value per share. So the next year the book value per share is becoming 26.5. The year next to it, the book value is becoming some 29.5, and here my dividend will be this book value plus whatever the EPS that is generated during this period. So the entire thing is what is getting paid off, which means by the end of this year the book value is becoming 0, because we are creating it as a liquidating dividend. Now in all these cases, this is the P&L statement and the balance sheet, that P&L statement that we are prepared, and the book value per share for each of these years. Now I can find out the charge to equity investors return. We are saying 12% based on the beginning value. So in the initial value, this is 24.9, and 12% of that, so almost $3 is the equity investors expectation. Whereas when it comes to the second year, this expectation is somewhere around 3.18, and whereas when it comes to the third year, the expectation is to the extent of 3.54. And what we are saying, the difference EPS minus R times BVPS is the residual income. So the residual income for each of these years, EPS minus whatever R times the book value per share. So each of these years the residual incomes are going to be something like this. So based on this, I can very well find out the present value. The present value of all the future residual income. Now after third year there is nothing else, because the company got closed down, will get closed down. So the present value of all the future is only for the next 3 years. So present value of future RIs. When I say present value of the future RIs, I will take NPV at the rate of 12%, these numbers. So this I will add up to the current book value, and I say the intrinsic value in this case is the present value of the future RIs plus the current book value. So whatever is the addition that is coming is only to the extent of $7.6, whereas 24.9 is already the currently existing book value. So that is where we say it's not that heavily impacted by the terminal value kind of a concept. So this is what is going into the determination of intrinsic value, especially when we are thinking of at the end of 3 years or 4 years, the business is getting winded up. But if the business is expected to go as a going concern, if the business is expected to continue for a longer period, go as a going concern, then what needs to be looked at? See, the simple logic which we are looking at is whenever, as long as the ROE is greater than R, the residual income is positive, which will result in market value is greater than the book value and the ratio of price to book value will be greater than 1. Otherwise, the market value has to match with the book value itself. So, this is what is a simple analysis that we will do by comparing the return on equity with the investor's required rate of return. Now, when I am looking at it on a continuous basis, let me again write down the equation that makes things very easy for you. B naught plus RI1 divided by 1 plus R, RI2 divided by 1 plus R squared, plus so on, plus RIN or RI infinite divided by 1 plus R to the power infinite. So, this is the typical model wherever we are looking at the valuation using the residual income method. Now, in this, when I say single stage model, right from this year to this year, there is a constant growth rate of G. But when I am talking about a multi-stage model, right, just like in a dividend discounting case or in some other free cash flow kind of discounting case, from here to some period, there is going to be a supernormal growth rate G1, and from there onwards, there is going to be a kind of a constant growth rate, right? From there onwards, there is going to be a constant growth rate. The same logic gets applicable even in case of the RI based models also. But the way we are handling them is, okay, wherever I have a superficial growth rate of something, I compute the RIs separately for each of the periods. So, let's say I am talking about RI5. So, for the next 5 years, I have the RIs computed, and from the 6th year onwards, there are different kinds of assumptions that are going ahead when it comes to the terminal value. When it comes to the terminal value, people are coming out with different kinds of assumptions. Some saying, okay, the RI from the 6th year onwards, RI from the 6th year onwards will continue at the same level as the 5th year. The RI in the teeth year or in the nth year, from nth year onwards, probably let me try to put it something, from nth year onwards, the RI will be the same as the RI of n-1th year. That is what we say, the RI is expected to persist at the current level. So, what is happening? For the first 5 years, there are different RIs that are coming up, right? RI1 by 1 plus R, RI2 by 1 plus R squared, RI3 by 1 plus R to the RI5 to the power 1 plus R to the power 5, and from the 6th year onwards, the RI is going to be the same as RI5 only. 1 plus R to the power 6, RI5 by 1 plus R to the power 7 up to infinite. Now from here this is looking like a constant dividend kind of a model up to infinite. So here the value of it I can very well find out as RI5 divided by whatever is the RI6, which is same as RI5 only. Probably let me take it as RI6 divided by R. That is what is the present value at the end of the 5th year from the for the RIs from the 6th to the infinite period itself. The same way the other assumption could be from the 6th year onwards the RI will become 0. From the 6th year onwards the RI will become 0. So immediately when the RI is becoming 0 from the 6th year onwards there is nothing else. So this is coming out as 0 itself. Similarly, it may so happen that RI is not maintained at that particular level, or it's not even going to 0 immediately, it's somewhere in the middle. Let's say I am assuming that the initial year it is RI 5 into, it has dropped by 20%. So it comes out like RI 5 into 0.8 divided by 1 plus R to the power 6. The next period RI 5 into 0.8 squared, assuming that every period the RI is getting dropped by 20%. Right? If the RI is dropped by 100%, then it is becoming 0. If the RI is dropped by 0%, it is maintaining at 1 itself. So if I am saying that the RI is dropping at 20%, now what will happen? Probably if I am trying to find out the present value using again a geometric progression kind of a mechanism itself, if I take out, let's say 1 plus R to the power 5 out, this is nothing but RI into 0.8 by 1 plus R, RI 5 into 0.8 square by 1 plus R squared. This is an infinite term of the geometric progression. So the sum of those infinite terms, the first term which is RI 5 into 0.8 divided by 1 plus R, this is the first term, divided by 1 minus whatever is the ratio. The ratio is 0.8 by 1 plus R. So which will come out as RI 5 into 0.8 divided by 1 plus R minus 0.8. This is what is coming out. So what is typically coming out here? This RI 5 into 0.8 is nothing but RI 6. So when we are trying to find out the present value, in all these cases there is a generalized thing that has come out. If at all I want to find out the present value of the RIs at the period t minus 1, all I am saying is find out the value of RI for the period t and use the formula of 1 plus R minus W. If W is 1, then it means the RI is going to persist at the same level, because this is RIT by R, which was same as RI 6 to be RI 6, 7, 8, 9 all going to be at the same RI as of the 5th year itself. But if I am taking this value as 0, the 6th year's RI divided by 1 plus R, because all others are becoming 0 altogether. Now if it is becoming only 80% of the previous RI, then probably it is becoming 1 plus R minus 0.8. So W is taken as 0.8. So W is taken as what is called as a persistence factor. The higher the W is, so it lies between 0 and 1. If it is 1 means the RI is going to be the same as the previous year forever. Or if I say W is equal to 0, I am assuming that RI is going to drastically fall to 0 immediately, and RI lying anywhere between 0 and 1, I am assuming that the residual income is going to fall, but at a gradual rate, fall to 0 but not immediately, but at a gradual rate. If it is very close to 1, the fall is very slow. If it is very close to 0, the fall is going to be much faster. So these are the different ways I can estimate the terminal value in case of multi-stage model. And the other interesting thing is, without getting into this persistence factor and all these things, we are saying, okay, Ri1 by 1 plus R, okay, Ri5 by 1 plus R to the power 5, then Ri6 by 1 plus R to the power 6 and so on. Now what we are saying is, whatever are these numbers, as of the 5th year, this should reflect the price. This should reflect the price at the 5th year. Right? The present value of the 6th to infinite period, this should reflect what should be the price of the security at the end of the 5th year. So I will, by using some kind of price multiples or some other approach, if I find out what is going to be the price at this particular period, then instead of taking Ri6 and the infinite, I'll take P5, add it to Ri5 and then find out the present value. That is one more method. So what we are saying is, the P5, the excess over the BT, over the book value at that point. So that is what is the present value of all these Ris, Ri6 till infinite. That is the excess of price, P5 minus B5. The excess of the 50, excess of the price, if the Ris were not there from the 6th year onwards, the market price and the book value should be the same. If there is an excess, that difference is the sum of all the residual incomes from the 6th year to the infinite year onwards. So that I am adding to the Ri's, the teeth period Ri, and again using it as a part of my discounting process. So basically, so though this much of concept is existing, the simple way to look at the intrinsic value is current book value plus the present value of all the future Ris that are going to come up. And that future Ris, because we are using a multi-stage model, up to some period we are thinking of some kind of higher growth, and after a certain period we are thinking of a continuing Ri, where the patterns are thought of as either persisting at the current layer itself, or dropping immediately to 0, or dropping gradually to a certain percentage, or probably whatever is the difference between the market price and the book value at that point is the present value of all the future Ris from that point onward. So using any of these mechanisms, we can very well get into the finding out the value of the security using this residual income based models. So we can take up one numerical to work out this entire end-to-end kind of scenario. So for that I am taking one single numerical, probably with the various all the 4 approaches. What if I see that the Ris are going to fall drastically or gradually, or these kind of things. So let's try to go ahead looking at the numbers. Okay, so basically the same logic, if I have to continue, we have to start with the current BVPS. Okay, we'll take year 0, year 1, year 2, year 3, year 4 and year 5, right? So the book value per share, I'll take the BVPS, the book value per share. Initially, yes, that is around $20.5. Then we are talking about the EPS. So let me start with the EPS estimates. For the first year it is 1.5, then it is 3.2, then it is 3.1, 4.4 and 5. These are the EPS. Then we are talking about the dividends, right? They are talking about the dividends that are getting paid off, 45%, 55%. So out of this I'll take 45% as the dividend. Out of this I'll take 55% as the dividend second year, 40, 40 and 55. So third year also I am taking 40%. Fourth year also I am taking 40% as the dividend, and in the fifth year also I am taking 55% as the dividend. So because EPS minus the dividend is what is going to add up to the book value per share, right? Out of the EPS, whatever the dividend is going to go off, that is what is going to add up to the book value per share. So I will put it as at the end of the first year, the first year's book value, the beginning of the period, plus EPS minus the dividend, whatever is getting paid out. So the book value per share is typically increasing in each of the years at this particular level, right? The book value per share in each of the years is increasing at this particular layer. Even for the fifth year, the book value is the previous year's book value plus EPS minus the dividend. So these are the book value per shares for each of the years. Now we are seeing that the expected ROE for the next 5 years, even the ROE, okay, this is not the required rate of return, right? Expected ROE for each of the years, how much? 14.1%, 12%, sorry, 12.1%, 13%, 15% and 11.8%. These are the expected ROEs for each of the period. Okay, these are the expected ROEs for each of the period, whereas the R is only 9.25%. So based on this I can find out the R into BVPS, which has to be subtracted to find the residual income. So R into BVPS, R is a straightforward 9.25% per each of the years, 9.25% into BVPS at the beginning of the period. So this is what is the R times BVPS for each of the years, which is the residual income for each of the, no, this is the R times BVPS. So residual income is nothing but the net income or EPS minus the R times the BVPS. That is what will form as the residual income. So this is what is going as the residual income for the future. This is what is going as the residual income for the future. Okay, ROE is 14.1%, whereas we are seeing that the company has generated in fact the ROEs are not required here, so let me take them out. In fact, in this numerical, the ROEs are actually not required. It's better that we compute the ROEs. If the EPS is given, I don't need ROE, and if the ROE is given, I don't need the EPS. So probably let's stick to one of them. Assuming, let's say I'm not sticking to the EPS. Otherwise, I'll keep the ROEs just to understand the numerical better. I'll keep the ROEs, but I'll not look at the EPS at all. So let's say I'm removing the EPS. So what is coming out is, in the first year, the book value of share is this much multiplied by the ROE. That is what is coming out as the EPS for the first year. The same way when I am continuing it, all I would be getting is these are the EPSs over each of the years, which is resulting in the residual incomes of these kind of numbers. Now what we are saying is, okay, the book value has changed to these kind of numbers. I don't need this much this part as a part of my example at all, because these two are creating some kind of differences in the numerical. So EPS I am deriving based on ROE as well as the BVPS itself. Okay, so now these are my RIs. Now what I am saying is, from these are for the 5 years. Now from the 6th year onwards, let's say if the RI are going to be 0 itself, which means the persistence factor, logically speaking, if the ROIs are going to be 0 from this period onwards, how do I find out the present value here? The present value, I could have taken the NPV at the rate of 9.25%, calculate these are my future cash flows or future RIs, and add up the book value per share as of today, and all the others are going to be zeros. So the present value is coming out to $24.07. And using our formula, what are we saying? Using that RIT by 1 plus R, probably I could have taken RIT, the next period's RI 0 divided by 1 plus R, which is actually leaving me only with this much, which is what is again working out to the same number itself. But if I take the second scenario, RI remains at the same level as that of the 5th year. So right from the 6th year, let's say if I am assuming that my RI is always this number itself. So what can I do? From here onwards, it is going to be a constant dividend for the infinite period. So I would have simply taken here the RI as nothing but the RI of the next period divided by the R, which is 9.25%. So at the end of the 4th year, I am getting this as an additional value. So when I am computing the PV in the second case, I am doing it as, okay, book value per share plus whatever is the NPV that is coming out of these 4 periods, for these 4 periods, and the 5th period one, 5th to infinite, which is growing at the same rate, I can discount this by the 4-year period. So if you just plan it out, it is straightforward rather than remembering the formulas. So I am discounting it by 1.0925 to the power 4. So if I assume that the RI is going to persist at the same rate as that of the 5th year, I am saying that the present value or the value of this particular equity security is going to be somewhere at around 28.91. And if I am making, no, it will not persist at the same layer, but it will drop down. It will drop down to 0 with a persistence factor of 0.3, which means I am saying that this will grow the next year's RI will be 0.3 times the previous period's RI, something like this. So from here onwards again, I can very well do it as an infinite series, or what we are saying here is the present value of all these things, the present value is nothing but the next period RI divided by 1 plus R 9.25% minus W, which is the persistence factor. So this is what is coming out as 0.88. The present value of all these things is coming out as 0.88. So which means when I am doing the present value for that kind of a security, which is for whom the RI for the next period is from the 6th year onwards, the RI for the next period is 30% of the RI of the previous period, I can very well find out the value of that security. Book value per share current plus the NPV at 9.25% for these 4 periods, and also this 5th period, whatever is from 5th to infinite period, found out to the end of the 4th period, I'll discount it by 4 years. So overall this is working out to 24.23. If at all I am assuming that the persistence factor is somewhere around 30%, I am assuming that the present value of such a kind of a share to be around 24.23 kind of a percentage. And then the 4th scenario, all we are saying is assume that the price at the end of the 5th year is 30% more than the book value. So at the end of the 5th year, the book value is somewhere around 28.82. So based on this, I am assuming that the price at the end of the 5th year is going to be somewhere around the 30% more, going to 37.46. So from the 6th year onwards, whatever the RIs are going to come up, the present value of all those RIs is going to be an excess of, in the 5th year, the excess is to the extent of 37.46 minus the book value. So I am assuming from the 6th year onwards, whatever was the excess, the present value of that is equal to 8.64. Now based on this, I can find out the present value again, the book value of share plus whatever for the first 5 years, whatever is the NPV that is coming out at the rate of 9.25% for these 5 things, and from the 6th year onwards, whatever the value that is going to come up, this is the present value of all the 6th year onwards kind of stuff. So take this and divide it by 1.0925 to the power 5. So going with this assumption, probably it is looking like the present value of the share is going to be somewhere around $29.62. So that is how we use these 4 different kinds of mechanisms under the assumption of either persisting at the current RI level or dropping immediately to 0 or dropping gradually, or finding out the terminal value based on some assumption, finding out the price at that particular point in time based on some assumption like a price multiple, and using the difference as the present value of all those RIs from the next period onwards. So using that, I can find out the present values and find out the value of the security using that specific process. Now generally we see that residual income models have a very less impacting terminal value. We have seen here the terminal value is the difference of just 8 from the 6th year onwards till infinite. The impact is only 8.64, whereas the book value is to the extent of 20. So the book value forms a very significant portion of the value in a large number of cases. So the impact of the terminal value is very limited. So that's where sometimes people prefer using the residual income models above the other set of dividend discounting or free cash flow kind of models. And everything is based on the accounting data itself, which is a plus as well as a minus, because the manipulations are very much possible on the accounting data. So we have to be very careful in terms of doing these kind of computations. and especially where I cannot apply the dividend discounting models and free cash flow models, especially when a company is not declaring a dividend or when the free cash flows are negative kind of scenarios. It's better to go with residual income kind of models itself. But I have to take ample care in terms of making all the necessary adjustments to compute either EBITs or net income, like whatever are expense, try to capitalize them, like R&Ds and the operating leases and all, whichever are expense, try to capitalize them. All these kinds of adjustments are expected before using the valuation model. And yeah, this is what is a challenge. Clean surplus relation. What is this clean surplus relation? Till now, whatever we are talking of, the net income minus the dividends is actually going as a part of the retained earnings, which is again going into the book value of the equity. Now, there are so many items like foreign currency translation gains or losses. We have seen so many, even in case of multinational accounting. Sometimes an element does not go as a part of the net income, but it goes directly into the balance sheet. So wherever we are seeing the particular entity does not get reflected, expense, a gain or a loss does not get reflected in the net income, but it goes directly into the equity. Those kind of transactions will impact the clean surplus, because wherever we are taking an entry not through the net income route but directly into the balance sheet, like as I was talking of cumulative translation allowance, valuation allowance, foreign currency translation differences, all these things, they are going directly into the balance sheet itself, bypassing the income statement. So that kind of relationship in accounting is what we are calling as dirty surplus accounting, whereas anything that is going through the net income and from there after the dividend going into the retained earnings, which is impacting the book value of the equity, that is what we are calling as a clean surplus accounting. So there is whenever I am using this residual income model, I am making an assumption that the clean surplus accounting is holding true, and in case it is violated, it forms a very big impact on the worthiness of the residual income models, because whatever is the difference from the net income, we are directly adding up to the book value of the equity. But in case the book value of the equity directly increases because of these kind of allowances, then it forms very difficult thing in terms of using the residual income model. So whatever, especially some kind of uncertainties that are coming up with the return on equities and the book value predictions also impact the residual income models to a large extent. And just to finally see, whenever we are using the residual income models, we have to make sure that anything that is impacting the clean surplus relationship, you do the negation of those transactions. Whatever is being represented as a part of the other comprehensive income in the balance sheet, make sure that it is coming into the income statement and getting accounted for. Any balance sheet adjustments that we are doing for the fair value, because sometimes again that would result in the something getting added to the other comprehensive income, bypassing the income statement. All these things will have an impact on the residual income calculation. So basically we have to see if such kind of things are coming up, we make the necessary adjustments, bring them into the income statement so that the residual income can be calculated quite appropriately, and make sure that all the non-recurring items and all, for computation of the EPS purpose, we get into the process of normalizing all that EPS, wherein we remove all the non-recurring items in the computation before going forward with respect to the computing the residual income itself. And any other aggressive accounting practices are there in terms of showing everything as a part of operating lease or showing everything as a part of R&D expense. It's better that we capitalize them and show expenses in a gradual manner rather than aggressively showing everything as an expense. And especially working out on the international differences, make sure that we are comparing when we are doing a valuation, we understand the accounting practices of those particular countries and make the appropriate changes so that the residual income gets calculated in a better manner, which will help us in doing a better valuation of the firm. So this is what in a nutshell I wanted to talk about the residual income based valuation models. I hope you are comfortable in terms of understanding these various aspects of residual income valuation. In case you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.